Do you really know what your investments are earning? For example, let's suppose you bought a certificate of deposit at your local bank and that certificate of deposit pays 3% interest. You might assume that your capital is increasing at 3% per year. Unfortunately, that's not necessarily the case. To realistically evaluate the earnings on this hypothetical CD, we need to calculate the real rate of return of that investment. The real rate of return considers three factors: the nominal return on your investment, the impact that the current rate of inflation will have on the purchasing power of your earnings, and the income tax that will be due on your earnings. The nominal rate of return on this hypothetical CD is 3%. Now let's suppose that inflation is running at 2% per year. So the purchasing power of the CD's earnings will be reduced by that amount. If the owner of this CD is in the 33% tax bracket for federal income tax purposes, then 1/3 of the earnings, or 1%, will be paid out in taxes. If there is a state income tax, we should also deduct that amount for the nominal rate. However, for the purposes of our example, we'll leave state income taxes out of the picture. So, let's now calculate the real rate of return on our hypothetical CD. So in this case, the hypothetical CD is actually earning a real rate of return of 0%. And we thought we were getting a safe, secure return of 3%. However, the reality is we actually end up with nothing when we factor in how inflation impacts the purchasing power of our earnings and the tax hit we will take on those earnings. Let's take a look at another example. This time let's take a look at another type of investment, say a tax-free municipal bond paying 4%. Just as before, we take the nominal rate of return and subtract the inflation factor. We then subtract the income taxes. In this case, there are no federal income taxes on the municipal bond. Our net real rate of return is 2%. So in the case of these hypothetical municipal bonds paying 4%, we actually get to keep a net return of 2%. Let's do one more example. This time we'll add a small layer of complexity. Let's suppose you own a blue chip stock that earned 12% total return this year. The total return in this case was made up of 9% capital appreciation and 4% dividend income. To keep the example as simple as possible, let's suppose that we sold the stock and realized a long-term gain on the sale. The inflation rate remains at 2%. The current tax rate for both dividends and capital gains is 15% of your earnings, or 1.8%. If we do the math, we find that we earned a net real rate of return of 8.2%. So now you know how to quickly analyze the real rate of return on your investments. Just take the nominal rate of return, subtract the current inflation rate, and then deduct all the income taxes that would be due based on current tax laws. With this simple calculation, you'll know where you stand with your investments and there'll be no unpleasant surprises. Taking the time to make this calculation will help you better analyze and compare different investments and improve your investment decisions. You now have the secret to knowing what your investments are really earning for you. You now know about real rate of return. We'll have more for you in another installment of the Financial Briefing.